Too many beginning traders get excited about Forex and they jump into the markets without fully understanding what's at stake. Lesson 5 is all about teaching you how to calculate your profit, your loss, and your risk potential. The first concept you need to be aware of before you can understand any of this stuff is the fact that not all pips are created equal. How pips are handled depends on the quote currency. If the US dollar is the quote currency, meaning it's listed second in the pair, life is good. Life is easy. 1 pip equals $10 for a standard lot, which is 100,000 worth of currency. 100,000 units. If the US dollar is the base currency, meaning that it's listed first in the pair, life isn't so easy. In this situation, 1 pip is actually stated in the terms of the foreign currency. Therefore, before you know how much money you made or lost, you have to convert it back into US dollars. Usually, it's going to be about $10 a pip after the conversion, somewhere between 8 and 12. But the math isn't quite as simple as knowing that it's $10 and it's a good, clean, easy number to deal with. A pip will always be 1/100th of 1%, but its value is going to vary by the size of the trade. For instance, a standard lot, as we mentioned, is $10 if the USD is the quote currency. But a mini lot, which is 10,000 units rather than 100,000 units, has a pip value of $1 or about $1 for currency pairs in which the US dollar is not the quote currency. It might be $1.10, it might be 90 cents, but it's going to be in that vicinity. You might also hear people talk about microlots. Microlots are 1,000 units of a currency. Again, a mini lot is 10,000 units, a standard lot is 100,000 units, and a microlot is 1,000 units. Only certain brokerage firms will offer microlots. Microlots have a value of 10 cents per pip, or about 10 cents per pip if you're talking about a pair in which the US dollar is not the quote currency. If the USD is the quote currency, we know that each pip is worth $10. This makes life easy. A trader that goes long a standard lot or 100,000 units of the eurodollar at 133.20 and then later offsets the entire position at 135.70 just made a profit of 250 pips. Before we know how much we really made on the trade, we have to multiply 250 times $10, and we know that's equal to $2,500. Really simple, right? Unfortunately, making $2,500 in the market is not nearly as easy as this is. The math is easy. Making money, maybe not so much. Unfortunately, if the US dollar is not the quote currency, things get a little more complicated. This is because if the USD is the base currency, then any money that you make or lose, any pips, which are considered profit or loss, are quoted in terms of the foreign currency and then have to be converted back into US dollars. Because the conversion rate between the US dollar and the Swiss franc, or the US dollar and any foreign currency for that matter, is constantly changing, so are the pip values. In other words, we can calculate the value of a pip today, but that doesn't mean it's going to be the same thing tomorrow or the next day, and it might be dramatically different a year from now. It's always going to be right around the $10 mark, but trading is a game of accuracy, and you want to know exactly to the penny how much you're making or losing. Let's assume a trader goes long 100,000 units of the dollar franc at 91.93. We know that because the dollar is the quote currency, the 91.93 is actually the value of the dollar in terms of the franc. In this instance, $1 is equal to 0.9193 francs. If the trader later offsets his position by selling 100,000 at 92.50, the trader is profitable by 57 pips. Now, knowing that a pip value is probably going to be somewhere around $10, we can assume that the trader made $570. But before we know exactly how much the trader made, we have to convert everything back into US dollars. If the current value of the franc versus the dollar is 92.50, we know that it takes 0.9250 francs to buy $1. Therefore, we can figure the pip value by dividing 1 pip by the going rate and multiplying it by the contract size. Knowing that most currencies, leaving the yen out of this conversation, are quoted in 5 digits, with 4 to the right of the decimal, we know that 1 pip is actually the same as saying 0.0001. So we take that figure, 0.001, divided by 0.9250, which is the current rate of the franc versus the dollar, and then we multiply that by 100,000 units, which is the contract size, and we come up with 1081 per pip. This tells us that at this exact moment, with the current rate, 57 pips is actually a profit of $616.17. If you recall, we estimated it was about $570, but as we now know, it was actually a little better. Luckily, brokerage firms understand that if they make things as simple as possible for Forex traders, more people will be willing to trade Forex. Accordingly, trading platforms do all the math for us. We don't necessarily have to do this type of math on a daily basis, but it's a good idea to know how it works. Let's go take a look at a couple of easier ways to get the same information that we just discovered through the use of a calculator. Now that you're a little more familiar with the Forex markets and how they operate, let's go back to a trading platform, do a few examples, and take a look at how modern technology has made the life of traders much easier. We no longer have to do the rigorous math in Forex trading. It's all done for us. We'll start with taking a look at the dollar-yen. If you recall, when you're trading a currency pair, you're buying and selling the base currency, and the quote currency, which in this case is the Japanese yen or the JPY, simply gives us a relative value. Accordingly, any pips that we make or lose in this pair have to be converted to US dollars. Luckily, the platform will do all of that for us. A standard lot is 100,000 units, which in some platforms you might actually see it written out, 100,000, but a lot of platforms will do it in terms of millions. In this case, this platform does it in terms of millions. So we see 0.1, M. M stands for million, obviously. And what that tells us is we're trading 1/10 of a million, or 100,000 units, which is a standard contract. We also now know that there's a spread between the bid and ask, and if we're buying a contract at the market, we're paying the ask. Keep in mind, just because the ask is currently 81.21 doesn't mean that that's where I'm guaranteed a fill. If I'm buying at the market, I'm guaranteed a fill, and it's going to be the best fill that the market provides at that particular time, but it's certainly possible that as I hit the buy button, the ask slips. Let's go ahead and see how we fare. We're now long 100,000 units of the Japanese yen. And we can click over to our positions tab here and take a look and see how we're doing. You'll notice the profit and loss is going to fluctuate with every tick. I chose the US dollar Japanese yen, or the dollar yen, because it involves converting back into US dollars. Or at least it did 20 years ago when everybody had to do it by hand. Nowadays, we buy and we just follow the profit and loss column. The platform, if you notice, there's a dollar sign in front of the profit and loss. That's telling us that the platform is already taking the money that we're making or losing in yen pips and converting it to US dollars. Now, most platforms will let you denominate which currency you want to keep track of. What I mean by that is, I'm assuming that you're in the US and you're trading with US dollars, but you might be in Canada and your account might be funded in Canadian dollars. If that was the case, you could tell the platform that you want everything to be converted to Canadian so that you know exactly where you stand. Obviously, this is particularly slow day. The market's not moving much at all. In fact, we're not making or losing any money. Let's move our attention to the euro dollar, which is a little easier to keep track of. If you remember, in the euro dollar, because the dollar is the quote currency and the euro is the base currency, we know that each pip on a standard lot of 100,000 units is worth $10. We also know that on a mini lot, which is 10,000 units, a pip is worth $1. Let's buy 110,000 units at the market and see what that does for you. If you notice, we were immediately losing 1 pip, which was $10 plus the $1 for the extra 10,000 units we bought. So it's showing a profit and loss of $11. The great thing about trading platforms is they will provide you with stats. A lot like a baseball player wants to know how many RBIs he's hit, what his batting average is, a trader wants to know how they're doing. How many of their trades have been profitable, how many have been losers, what their average profit is, what their average loss is, their win-loss ratio. This type of information is key. It tells traders how they're doing. Are they improving? Are they getting worse? And it allows for adjustments. As we're finding out, each pip in the dollar yen is worth $12.32. Now, I could have figured that out by going through the long, well, it's not so long, but the mathematical process that I've just shown you, or we can just go to our platform and see that we're losing 2 ticks on the trade. Our average price is 81.21 and the market is at 81.19. 2 pips, 24.63 means 12.32 is the going rate for 1 pip in the Japanese yen. While we're waiting for our trades to materialize, I'll explain a couple of things about trading platforms. In Forex, there's probably just as many trading platforms as there are brokers. In fact, there's probably more because there's a lot of platforms developed by third parties. But what you need to know is, although they're all going to have different flashing lights, different shapes and sizes, they're all going to have the same basic information. Almost all Forex trading platforms are going to have these buttons. This is called a trading pad. A buy button, a sell button, different order types. Is a really brief rundown of what order types are. A limit order is when you're naming your price. You're saying, I want to buy a certain pair, but I don't want to buy it at the market price. I want to make sure I get a price that I'm comfortable with, and you name your price. A stop order is often referred to as a stop loss, and that's because it's generally an order type that people use to protect profits or to prevent the market from sliding too far against them. For example, if you go long the euro dollar at 132.02 and you're only willing to risk 2 pips on it, you might place a stop order at 132 even. That would be a stop order. A stop order becomes a market order once the market goes against you enough to reach this price that you specified. You might have noticed these quantities down below, and what these represent are the number of contracts working at the bid and the ask prices. Most trading platforms also give you the ability to trade from the charts. The positions that we have on really aren't moving very quickly. So let's take a look at the chart and see where we might have gone wrong. This is a chart of the euro dollar. We're long the euro dollar. In fact, we're long 110,000 units, which is one standard size contract and one mini, and we know that that's worth $11 per pip because 1 pip on a standard is $10 and 1 pip on a mini is $1. So obviously we add those together. But it looks to me like this market's probably a better sell than it is a buy. So we can go ahead and reverse our position. We're now short 110,000 units. And that occurred by when we hit the reverse button, we sold twice as many that we were long. Let's see if we can get the market moving for us a little more quickly here. I'm going to go ahead and sell 200,000 more contracts. You can see this leaves us net short, a little over 0.3 of a million. You'll notice on the chart platform, it doesn't give us a dollar profit and loss. Instead, it gives us a P&L in pips. Right here, we're losing a total of 3 pips based on our average entry price. We're short 3 standard contracts and 1 mini, or 0.31 million, or 310,000 units. And we also know that that's worth $31 per pip, because we have 3 standard contracts worth $10 a pip, 1 mini worth $1 a pip, and let's assume that we're losing 3 pips. That's $93. We can confirm this by going back to our platform. And there we go. We're losing $93 because we're down by 3 pips. Let's go ahead and close our positions. And we can do this by either hitting close or manually entering the opposite of what we were holding. And we'll do the same with the yen. And remember, in any platform, you can simply toggle between products. You don't have to open up new windows to trade different products. You just toggle. And we're going to go ahead and close that position as well. Again, no math is necessary. We can simply go to our account performance and view how much we made or lost in terms of the dollar, regardless of which pairs we're trading. In fact, we can even split things up and see how much we made or lost per pair. Not only does a trading platform tell us how much we made or lost in dollars, without us ever doing any sort of math or lifting a calculator, it also gives us our stats. Of course, we don't have to do all the math by hand, nor do we have to execute trades in a trading platform to determine what the pip value is. After all, don't we want to find out what the profit, loss, and risk is before we get into the market, not after? We don't want to trade and let our broker tell us how much we made or lost. We want to know that before we get in. We can do that using an online calculator similar to the one we used for the margin requirements. We'll go back to fxstreet.com, click on the Tools menu again, From here, we're going to go to the pip USD value. The greatest thing about this website is it allows us to calculate pip values for most of the major pairs all on the same screen. You might recall that I mentioned that anytime the US dollar is the quote currency, the value of a pip is always going to be $10 for a standard lot. It's always going to be $1 for a mini lot. And if you're bold enough to trade 1,000,000 units, it's always going to be $100. So it's no surprise that if we enter 100,000 units in our lot size and we hit update, that any currency that has US dollar as a quote currency is going to show $10 a pip. Obviously, if we went down to 10,000 units, which is a mini contract, and we hit update, we're going to see that a pip is worth $1. Now we'll get a little tricky here, and if we did 110,000, which is basically one full size contract and one mini contract, this should say 11, right? Now where this really saves us time is in currency pairs in which the dollar is not the quote currency, such as the dollar yen or the dollar franc. In this situation, any profit or loss that we make has to be converted to dollars, as we've learned over and over. But this time around, there's no math involved. Let's start with a standard unit of 100,000. Right now, at the current prices, we're talking about a little over $12 per pip in the dollar yen, about $11 per pip in the dollar franc, and in the dollar Canadian, we're talking right at $10 a pip. Now it's obvious from this that a pip is always going to be around the $10 mark. Remember, I told you it might be $8, it might be $12, it's probably going to be somewhere in between. So we know approximately, but we want to know exactly how much we stand to make or lose, and this is how we do it. There's one more calculator that this site might be useful for. If we go back to the Tools menu at the top, let's choose the Profit Calculator. Now keep in mind, not everybody is going to keep US dollars in their account. Some people are trading Canadian dollars as their base account currency. Some people might be trading overseas and they might have euro in their account. We're going to assume that we're holding US dollars in our account. But if we weren't, we could choose between some of the other major currencies. As far as currency pair, let's go with something we haven't traded before. How about the dollar Canadian? You notice the system automatically pulls the current quote. The current price of the Canadian dollar is 1.0123. Basically, it's close to par. It takes about a US dollar to buy a Canadian dollar and vice versa. The trade price, obviously, is the price that we're looking to buy or sell, and we can dictate whether or not that's what we've done. Let's assume that we went long at, let's go make it easy, make a round number, 98.70, and we did a standard unit, 100,000 contracts. Let's say that we offset our trade at 98.85. We hit calculate. From here we know we made $151.85. We made 15 pips, 98.70 to 98.85, and we knew it was going to be about $150, but until we ran it through either a profit calculator or we actually entered the order through a trading platform and discovered how much we had made or lost, we didn't know exactly. Now we do.